Before we dive in, please remember that I am not a licensed financial advisor or insurance agent. This video is for educational and informational purposes only. The information provided is not intended as financial or legal advice. Always consult with a qualified professional before making any decisions about your insurance coverage. You will spend over $100,000 on car insurance in your lifetime. Let that sink in for a second. $100,000. For the average American driver, that is a conservative estimate. That's more than the sticker price of almost any car you will ever own. It's a down payment on a house. It's a full college education for your kid. And for most of us, this massive sum of money just vanishes from our bank accounts every 6 months in a transaction we barely understand. You get that email notification, you open the bill, you see a number that seems to go up every single time, you grit your teeth, you pay it, and you ask yourself the same nagging question: what am I actually paying for? It feels like a black box, doesn't it? You're pouring thousands of dollars a year into this mandatory service, but if someone asked you to explain your policy in detail, could you do it? Could you explain the difference between your bodily injury liability limits and your uninsured motorist coverage? Do you know why your premium is $100 more than your neighbor's, even though you have a perfect driving record and they don't? If you're like most people, the answer is probably no. And that's not your fault. Today we are going to change that. We are going to pry open that black box. This isn't another boring video that will just throw industry jargon at you and put you to sleep. This is your masterclass. We are going to dismantle your car insurance policy piece by piece and show you exactly where every single one of your hard-earned dollars is going. By the end of this journey, you won't just understand your bill, you will be in control of it. You will finally understand what all those cryptic lines on your declarations page actually mean for your financial security. You'll discover the hidden factors, like your credit score or your zip code, that can secretly inflate your rates. And most importantly, you will learn how to spot the overpriced, unnecessary coverage that insurance companies love to sell, so you can confidently slash your premium without ever putting yourself, your family, or your assets at risk. So why is this all so complicated? Let's be brutally honest. The insurance industry benefits from your confusion. They use language that feels like it was written by lawyers for lawyers. Terms like subrogation, tort limitation, stacking. It's an intentionally dense fog, because when you're confused, you don't ask questions. When you don't understand the product, you can't effectively shop for a better deal. You just accept the renewal rate they give you because the thought of trying to compare policies feels like trying to solve an advanced calculus problem. That power imbalance ends today. We are going to give you the translation guide. We're going to arm you with the knowledge that they are counting on you not having. Let's start at the very beginning with the absolute foundation. The 3 pillars of almost every auto insurance policy in the United States. You've definitely seen them listed on your bill. Liability, collision, and comprehensive. These 3 coverages are the engine that drives your insurance premium. They represent the bulk of what you pay for. Understanding them isn't just important. It is the first, most critical step to taking back control of your money. First up, the big one, liability coverage. This is, without a doubt, the single most important part of your entire policy. It is also the one part that is legally required in nearly every state. Here's the crucial thing to understand. Liability coverage does absolutely nothing for you or your car. It has zero to do with fixing your fender or paying your medical bills. Liability coverage pays for the damage you do to other people and their property. It's the "I am so sorry I ran that red light and T-boned your brand new SUV" coverage. It's the "I'm sorry I looked down at my phone and rear-ended you in traffic, and now your back hurts" coverage. It's not about protecting your assets. It's about protecting you from a lawsuit that could destroy your entire financial life. When you look at your policy, you'll see a series of numbers like 25/50/25 or 100/300/100. This isn't a secret code. It's your level of protection. The first number is the maximum amount in thousands of dollars your insurance will pay for bodily injury to a single person in an accident you cause. The second number is the maximum amount they'll pay for bodily injury for all people in that same accident. And the third number is the maximum they'll pay for property damage. That is, to fix or replace the other person's car, or anything else you hit, like a mailbox or a storefront. Now, many people just opt for their state's minimum requirement to get the cheapest price possible. This is one of the most dangerous financial mistakes you can make. Imagine your state minimum for property damage is $25,000. That sounds like a lot until you hit a new Tesla or a BMW or even just a fully loaded F-150. The replacement cost for those vehicles can easily exceed $50,000, $60,000, or even $70,000. Your insurance pays the first $25,000, and guess who's on the hook for the rest? You are. They will come after your savings, your investments, and they can even garnish your future wages for years. The same goes for bodily injury. A $50,000 limit for a multi-person accident can be wiped out by a single ambulance ride in one night in an emergency room. If you cause an accident that results in serious long-term injuries, the medical bills can run into the hundreds of thousands or even millions of dollars. If your liability coverage isn't enough, you could lose everything you've ever worked for. This coverage isn't just car insurance. It's wealth protection. Next up is collision coverage. Now we're talking about your car. Collision is exactly what it sounds like. It pays to repair or replace your vehicle if it's damaged in a collision with another object. That object is usually another car, but it could also be a telephone pole you backed into, a guardrail you scraped, or a curb you hit a little too hard. The key here is that it covers damage when you are at fault, or in a hit and run, or in any situation where the other party's insurance isn't paying. Collision coverage has a partner, and its name is the deductible. The deductible is the amount of money you have to pay out of your own pocket for repairs before the insurance company pays a single dime. Think of it as your copay for a car crash. If you have a $1,000 deductible and the repairs cost $5,000, you pay the first $1,000, and your insurer covers the remaining $4,000. If the damage is only $800, your insurance pays nothing. It's all on you. This is a trade-off. A higher deductible, say $1,000 or $2,000, means you're taking on more risk yourself, so the insurance company will reward you with a lower monthly premium. A lower deductible, like $250 or $500, means you'll have less to pay after a crash, but your premium will be higher every single month. Choosing the right deductible is about finding the sweet spot between what you can afford to pay monthly versus what you could comfortably pay out of pocket on your worst day. Finally, we have comprehensive coverage. This is the third pillar. Think of this as the acts of God and bad luck policy. Comprehensive covers damage to your car from almost everything except a collision. A hailstorm turns your hood into a dimpled mess? That's comprehensive. A deer decides to leap in front of your car on a dark road? Comprehensive. A tree branch snaps during a windstorm and crushes your roof? Comprehensive. It also covers theft, vandalism, fire, flooding, and even hitting a bird. It's for all the random, unpredictable events that can damage your car when it's just sitting there, or when you're driving along minding your own business. Just like collision, comprehensive coverage comes with a deductible that you have to pay first. And just like collision, the cost of this coverage is directly tied to the value of your car. A brand new $60,000 truck is going to cost a lot more to cover with collision and comprehensive than a 10-year-old Honda Civic, because the potential payout for the insurance company is so much higher. So there you have it. Liability protects everyone else from you. Collision protects your car from you. And comprehensive protects your car from the universe. These three coverages form the core of your premium and are the essential building blocks we need to understand before we can start to uncover where the real savings are hidden. So let's break them down, starting with the one that's legally required almost everywhere: liability. This isn't for you. This is for everyone else. Liability coverage is your financial apology to the world when you mess up. If you run a red light and T-bone a minivan, your liability insurance pays for the other driver's medical bills and the cost to repair or replace their vehicle. It's the "I'm sorry I ruined your day" and your car fund. When you look at your policy, you'll see a string of 3 numbers, something like 25/50/25 or 100/300/100. This isn't a secret code. It's the absolute limit of your apology. The first number is the maximum amount, in thousands of dollars, your insurance will pay for a single person's injuries in an accident you cause. So a 25 means $25,000. The second number is the maximum total they'll pay for all injuries in that one accident. A 50 means $50,000 total, even if 5 people are hurt. And that third number? That's the maximum they'll pay for all property damage, fixing cars, mailboxes, storefronts, whatever you hit. Now, here is the single most important and most terrifying thing you need to understand about car insurance. Most states have a legal minimum for liability coverage, and it is dangerously catastrophically low. We're talking levels like 25/50/25. Let's play that out. Imagine you're on the highway. You glance down at your phone for 1 second, and you slam into the back of a brand new Lexus. The driver gets a severe case of whiplash and a broken arm. Their passenger gets a concussion. The Lexus is totaled. Let's do the math with that state minimum policy. The driver's initial hospital visit and therapy costs $30,000. Your policy has a limit of $25,000. You are now personally on the hook for the extra $5,000. The passenger's medical bills are $20,000. Okay, your policy covers that because the total for both people is $50,000, which is your limit. You just got lucky. But what about that Lexus? A new one costs $60,000. Your property damage limit is $25,000. The insurance company writes a check for $25,000, wishes you the best of luck and walks away. You are now personally responsible for the remaining $35,000. In a single 1-second mistake, you are now $50,000 in debt. Your savings? Gone. Your wages can be garnished. They can put a lien on your house. All because you chose the cheapest insurance, which was really just the biggest gamble. The state minimum isn't designed to protect you. It's designed to provide a tiny token amount of protection for the people you might hit. It's the bare minimum society will tolerate. Upgrading your liability limits from, say, 25/50/25 to 100/300/100 might only cost you an extra $20 or $30 a month. It's the cheapest life ruin prevention plan on the planet. Okay, so that's liability protecting everyone else from you. Now let's talk about collision and comprehensive. These are the coverages that protect your car. They're usually sold together, and if you have a loan or a lease on your car, the bank will almost certainly require you to have them. Collision pays to fix your car when you hit something, another car, a pole, a guardrail. It doesn't matter whose fault it is. If your car collides with an object, this is what you use. Comprehensive is for almost everything else. It's the acts of God and chaos coverage. A tree falls on your car, a deer jumps in front of you, a hailstorm turns your hood into a golf ball, your car gets stolen, a rock cracks your windshield on the freeway. That's all comprehensive. The key to understanding these two coverages is one word: deductible. A deductible is the amount of money you have to pay out of your own pocket for a repair before the insurance company pays a single dime. Think of it as your copay. If you have a $1,000 deductible and you get into an accident that causes $5,000 in damage, you pay the body shop the first $1,000, and your insurance covers the remaining $4,000. And here's how you can start to control your premium. The deductible and the premium have an inverse relationship. A high deductible, like $2,000, means you're taking on more of the initial risk yourself. The insurance company likes that, so they give you a lower premium. A low deductible, say $250, means the insurance company is on the hook for almost everything, so they charge you a much higher premium for that peace of mind. Choosing your deductible is a personal risk calculation. You have to ask yourself, what's the most I could comfortably pay out of pocket tomorrow without warning if my car gets wrecked? If that number is $500, then that should be your deductible. If you set it at $2,000 to save a few bucks on your premium, but you don't actually have $2,000 in an emergency fund, you've just bought a repair plan you can't afford to use. So now we have the big three. Liability for them, collision and comprehensive for you. When people walk into a dealership and a salesperson says, "You're going to need full coverage on this," this is what they're talking about. Liability plus collision plus comprehensive. But here's a secret. Full coverage is not a real insurance term. It's a marketing phrase, a piece of slang. It doesn't exist on any actual policy, and it can be misleading because it implies that you're covered for everything, which is never true. There are always exclusions. There are always limits. And more importantly, it leaves out some incredibly crucial, yet often inexpensive, optional coverages that can save you from financial disaster. The first is called uninsured or underinsured motorist coverage. Let's go back to our highway accident scenario. But this time, you're the one driving the Lexus. You're obeying the law, singing along to the radio, when someone glued to their phone slams into you. They have that cheap state minimum policy. Your $60,000 car is totaled, and your medical bills are $30,000. Their policy only has $25,000 for your car and $25,000 for your injuries. Who pays the rest? You do. Unless you have underinsured motorist coverage. This is insurance you buy to protect yourself from people who didn't buy enough insurance. It steps in and acts like the other driver's insurance, covering the gap between their pathetic limit and your actual costs. It is, without a doubt, one of the most important coverages you can buy, because you cannot control the financial irresponsibility of other drivers. Then there's medical payments coverage, or MedPay, and personal injury protection, or PIP, depending on your state. These are designed to pay for your and your passenger's medical expenses right away after an accident, regardless of who was at fault. Why is this important? Because fault can take weeks or months to determine. While the insurance companies are arguing, hospitals and doctors want to be paid now. MedPay or PIP steps in and handles those initial bills, so you don't have to stress about it while you're trying to recover. It covers health insurance deductibles, copays, and sometimes even lost wages. It's a relatively cheap add-on that provides immediate financial first aid. So we've built our basic policy. We have liability to protect our assets from the world. We have collision and comprehensive to protect our car. And we've added the critical shield of uninsured motorist coverage to protect us from the world. We understand the trade-offs between limits and deductibles. This is the fundamental structure of your car insurance premium. But this is just the chassis. The price for this exact same package of coverages isn't one flat number. It's a deeply personal calculation. It's based on a secret risk profile that every insurance company is building on you right now, using data points you might never even think about. And in the next part, we're going to tear that profile wide open and expose exactly how they decide what you specifically are going to pay. So let's do it. Let's pull back the curtain. Every insurance company has a file on you. Think of it like a secret dossier, a financial fingerprint that predicts your future. And the single most important document in that file, the one that sets the foundation for your price, is your birth certificate. I'm talking about your age. This isn't just about being young and reckless. It's cold, hard data. For an insurer, a 16-year-old driver isn't a person. They are a statistic. And that statistic is terrifying. The CDC reports that the crash rate per mile driven for 16 to 19-year-olds is almost 3 times the rate for drivers 20 and over. They are statistically more likely to speed, to not wear a seatbelt, to misjudge gaps in traffic, and to get distracted. So when an insurer sees a 16, 17, or 18-year-old on a policy, they don't see a high school kid. They see a massive flashing red light, a walking, talking, driving liability. And they price that risk accordingly, charging premiums that can feel absolutely punishing. But it gets better. As you move into your early 20s, the rate starts to drop. You're gaining experience. You're making fewer rookie mistakes. The real magic, however, starts to happen around age 25. This is a milestone in the insurance world. It's the age where, statistically, your brain's prefrontal cortex, the part responsible for rational decision-making and impulse control, is fully developed. You are, quite literally, a different person than you were at 19. And your rates reflect that, often taking a significant dive. From 25 up into your 60s, you enter the insurance sweet spot. You are now a known quantity. You have years, even decades of driving experience. You're more likely to be settled, maybe with a family, a mortgage, things that statistically make you a more cautious driver. You are the ideal customer. Your rates during this period will be the lowest they'll ever be, all other things being equal. But then, something interesting happens. As you enter your late 60s and 70s, you might see your rates start to creep back up again. It's not as dramatic as the teenage years, but it's there. Why? Again, data. Older drivers can experience declines in vision, hearing, and reaction time, leading to a slight uptick in accident frequency. Feels unfair, but to the algorithm, you are simply a number drifting back into a higher risk category. So age sets the baseline. But the next factor is what you do with that age. I'm talking about your driving record. This is the story you write every single time you get behind the wheel, and insurers are reading it like a novel. A clean record is your golden ticket. Tells them you are predictable, reliable, and, most importantly, profitable. But the moment that record gets a blemish, the story changes. And not all blemishes are created equal. Think of it in tiers. At the bottom, you have minor violations. A parking ticket? They don't care. A fix-it ticket for a broken taillight? Probably won't affect you. But a speeding ticket for going 10 miles over the limit? That's different. That's a mark. It's a data point that says, this person is willing to break the rules. It might only bump your premium by 10 or 15%, but it's a crack in your perfect profile. The next tier up is for more serious moving violations. Running a red light, reckless driving, causing an at-fault accident. Now the algorithm is really paying attention. This isn't just breaking a rule. It's demonstrating dangerous behavior that directly leads to the very thing they have to pay for. Crashes. An at-fault accident on your record is a financial gut punch. Can easily jack up your rates by 40, 50, or even 60%, and that increase can stick around for 3 to 5 years. Do the math on that. A single mistake, a moment of inattention, can cost you thousands of dollars over the long haul. And then there's the top tier, the absolute deal breakers. A DUI or a DWI. This is the scarlet letter of the insurance world. It tells an insurer that you have engaged in catastrophic decision-making. You are no longer just a risk, you are a massive liability. Your premium will, without question, skyrocket. We're talking double, triple, or even more. Many standard insurance companies will drop you altogether, forcing you to seek high-risk, specialty insurance that costs a fortune. A DUI on your record isn't just a legal problem, it's a multi-year financial sentence. But here's the thing about your age and your driving record: you have some control over them. You can't stop getting older, but you can choose to drive safely. The next factor, however, is one that feels completely out of your hands, yet it has a monumental impact on your wallet. It's where you live. Not your state, not your city, but your specific 5-digit zip code. You could be the world's safest driver, a 45-year-old with a spotless record for 25 years. But if you move 2 miles down the road, from a quiet suburban zip code to a dense urban one, your premium could jump by hundreds of dollars a year. Why? Because you didn't just move your house. You moved your car into a different risk pool. Insurers are using your zip code as a proxy for a whole host of environmental risks. They are looking at hyperlocal data. What's the rate of car theft in your neighborhood? How about vandalism? How many claims for break-ins are filed on your block? They have this data and they use it. They also look at traffic patterns. Is your new home on a busy 4-lane road with a high accident rate, or a quiet cul-de-sac? They look at population density. More cars packed into a smaller space means a higher likelihood of fender benders, sideswipes, and parking lot dings. They even look at the weather. Does your zip code have a history of major hailstorms that lead to a flood of comprehensive claims? Is it in a low-lying area prone to flooding during hurricanes? Your personal driving skill is irrelevant when a tornado or a flash flood is coming for your car. You are paying for the accumulated risk of all your neighbors. But the profile they're building on you goes even deeper, into territory that seems to have nothing to do with driving at all. Let's talk about your credit score. In every state except for a handful like California, Hawaii, and Massachusetts, your insurer is pulling a version of your credit report. They call it a credit-based insurance score. They argue, and have the mountains of data to back it up, that there is a direct statistical correlation between how a person manages their finances and how likely they are to file an insurance claim. The logic from their perspective is this: a person with a high credit score has a demonstrated history of meeting their financial obligations, managing debt, and being responsible. They see this as a sign of a generally cautious and forward-thinking person, who is likely to also be a cautious and responsible driver. Conversely, someone with a low credit score might be seen as more likely to take risks, not just financially, but behind the wheel. They might also be more likely to file small borderline claims because they don't have the cash on hand to cover a minor repair. It feels deeply personal and invasive, but to the insurer, it's just another powerful predictor of future behavior. A poor credit score can literally cost you more than a speeding ticket on your insurance bill. And the personal questions don't stop there. Are you married? Statistically, married people file fewer and less expensive claims than single, widowed, or divorced people. The data suggests they live more stable lives and take fewer risks. So, a married person often gets a slightly lower rate. What do you do for a living? Some occupations are correlated with lower risk. An engineer or a scientist might get a better rate than a delivery driver or a journalist who is constantly on the road. Do you own a home? Homeowners are seen as more stable and financially responsible, often resulting in a small discount. Every single one of these data points, your age, your driving history, your address, your credit score, your marital status, your job, is a brushstroke. And together they paint a portrait. It's a digital ghost of you built from pure data. This portrait is what the insurance algorithm sees. And its sole purpose is to answer one question: how much of a risk are you? How likely are you to cost them money? The price you are quoted is their answer to that question. But this is only half of the equation. We've been talking about you, the driver. But what about the other half of the risk? The thousands of pounds of steel and glass you're driving. The car itself is a massive variable in this pricing game, and the ways they calculate its risk are just as detailed, and in some cases, even more surprising than the factors in your personal profile. Let's start with the most obvious factor: the car's sticker price, or more accurately, its replacement value. A brand new $80,000 BMW M3 is, without question, going to cost more to insure than a 12-year-old Toyota Corolla with 100,000 miles on it. This is the part everyone instinctively understands. If the BMW is totaled in a crash, the insurance company has to write a check for 80 grand. If the Corolla is totaled, that check might be for 8 grand. The insurer's maximum potential loss on that single vehicle, their exposure, is 10 times higher for the BMW. So, naturally, the premium will be higher. This is the baseline. But if it were that simple, this video would be over. The sticker price is just the cover of a very, very thick book. The real story, the one that creates massive swings in your premium, is hidden in the pages of repair costs. It's not just about replacing the whole car. It's about fixing it after the thousands of minor to moderate accidents that happen every single day. Let's take a simple fender bender. On that old Corolla, a new bumper cover, a headlight, and a few hours of labor might set the insurance company back $1,000. Now let's look at a modern luxury SUV, even one that costs less than that M3. That front bumper isn't just a piece of plastic anymore. It's a sophisticated piece of technology housing multiple sensors for adaptive cruise control, parking assist, and pedestrian detection. That headlight isn't a $50 halogen bulb. It's a $2,000 adaptive LED matrix unit with its own cooling system and computer module. A minor parking lot bump that would be a nuisance on the Corolla can easily become a $10,000 claim on the new SUV. The insurers know this. They have databases filled with millions of claims, detailing the average repair costs for nearly every component on every model of car sold in the last 20 years. They know that a car with carbon fiber body panels or a specialized 3-stage pearlescent paint job is an exponentially more expensive risk to have on their books, not because it's more likely to crash, but because when it does, the bill will be astronomical. But here's where the logic gets turned on its head, and where you can get caught completely off guard. A cheaper, more common car is not always cheaper to insure. In fact, sometimes it's dramatically more expensive. Why? 2 words: theft rates. Insurance companies don't just care about crashes. They care about cars disappearing from driveways overnight. And what do thieves target? Not necessarily the rare exotic supercars that are hard to sell and easy to track. They target common, high-volume vehicles. For years, the most stolen cars in America have been things like the Honda Accord, the Honda Civic, and full-size Ford and Chevy pickup trucks. Why? Because there are millions of them on the road, creating a massive anonymous market for stolen parts. A thief can strip a stolen Accord and sell the engine, transmission, airbags, and catalytic converter for more than the car was worth whole, and the parts are virtually untraceable. A perfect, recent example of this is the crisis with certain models of Kias and Hyundais. A design flaw made them incredibly easy to steal, a fact that spread like wildfire on social media. Suddenly, these affordable, economical cars became one of an insurer's biggest liabilities. Theft claims skyrocketed. In some cities, rates for these specific models doubled or tripled, and some insurers even refused to write new policies for them at all. So you could have a perfect driving record, but if you own a car that's on the most wanted list for thieves, you're paying a penalty. The insurer isn't pricing your risk. They're pricing the risk of your car being a magnet for criminals. They look at data from the National Insurance Crime Bureau, they analyze claims by zip code, and they know exactly which cars are being targeted where. Now let's pivot from crime to physics. Every car sold in the US is crash tested by organizations like the National Highway Traffic Safety Administration, or NHTSA, and the Insurance Institute for Highway Safety, the IIHS. You've probably seen the slow motion videos. These aren't just for consumer information. They are direct inputs into your insurance premium. But it's not as simple as 5-star rating equals cheap insurance. The insurers dig much, much deeper. They look at 2 different kinds of safety: crashworthiness and crash avoidance. Crashworthiness is how well the car protects you and your passengers during a crash. A car with a good rating from the IIHS in the small overlap front crash test is statistically proven to reduce the severity of injuries. Fewer and less severe injuries mean lower medical payouts for the insurer. This is the most direct link. When they have to pay out a personal injury claim, it can run into the hundreds of thousands or even millions of dollars. So, they give a significant discount to cars that are essentially rolling safety cages. They want you in a vehicle that can take a punch. But the new frontier is crash avoidance. This is your automatic emergency braking, lane keeping assist, blind spot monitoring, and rear cross traffic alert. The data is now overwhelmingly clear. Cars equipped with these systems are involved in fewer accidents. The IIHS found that front crash prevention systems can cut front-to-rear crashes by 50%. 50%. For an insurance company, that's a monumental number. That's half the claims they have to process, half the rental cars they have to pay for, half the repair checks they have to write. They are so incentivized to have you in a car with these features that the discounts are often substantial. It's a win-win, you're safer and they save money, passing a bit of that savings back to you. Finally, there's the most subjective, and perhaps most interesting factor of all, the car's personality. Insurers can't read your mind, but they can read your car's spec sheet. And a car with 500 horsepower, a top speed of 180 miles per hour, and a bright red paint job tells a very different story than a beige minivan with seating for 8. This isn't about prejudice, it's about correlation. Statistically, people who buy high-performance sports cars tend to use that performance. They accelerate faster, they drive faster, and they are involved in more frequent and more severe accidents. The car itself is a proxy for a riskier driving style. It's a concept called moral hazard. The very act of owning a car that is capable of extreme speeds changes the statistical probability of how it will be driven. Insurance companies have specific rating symbols for high-performance vehicles. They look at the horsepower-to-weight ratio. They look at historical claims data for that specific model. A Subaru WRX, a favorite among young enthusiasts, has a notoriously high insurance cost, not just because it's fast, but because the claims data for that specific model shows a history of expensive accidents. The insurer isn't just pricing the car. They're pricing the statistical behavior of the average person who chooses to buy that car. All of these factors, replacement value, repair costs, theft rates, safety ratings, and performance profile, are fed into a complex algorithm. Organizations like the Insurance Services Office, or ISO, provide a standardized system that most insurers use as a baseline. They collect massive amounts of data and assign what's called a Vehicle Series Rating, or VSR, to each specific year, make, and model. This creates a risk score based purely on the vehicle's claims history for different types of coverage. A car might have a low collision score because it's cheap to repair, but a high comprehensive score because it's stolen all the time. Your final premium is a blend of all these different scores. The car itself has its own unique financial fingerprint, a detailed profile of risk that is completely separate from you, the driver. It's a calculation of metal, plastic, glass, and data. And once the insurer has figured out the risk of the car, they then have to figure out the risk of the policy itself. Because what you're actually insuring, the specific promises the company is making to you, is the next massive piece of this puzzle. And once the insurer has figured out the risk of the car, they then have to figure out the risk of the policy itself. Because what you're actually insuring, the specific promises the company is making to you, is the next massive piece of this puzzle. Think of it like ordering a pizza. The base price is for the dough and the sauce, but then you start adding toppings. Pepperoni costs a certain amount. Extra cheese costs more. Olives, mushrooms, anchovies. Every single thing you add to the pizza changes the final price. Your car insurance policy is that pizza. The car itself is just the dough and sauce. The coverages you choose, those are the toppings. And some of those toppings are a lot more expensive than others because they represent a much bigger risk for the insurance company. So let's open up the menu and look at the 3 main toppings that make up almost every car insurance policy in America: liability, collision, and comprehensive. First, and most importantly, is liability coverage. This is the big one. This is the coverage that is legally required in nearly every state. And it's the one that can save you from financial ruin. But here's the key thing most people misunderstand. Liability coverage has absolutely nothing to do with your car or your injuries. 0. Liability coverage pays for the damage you do to other people and their property. Let me say that again. Pays for the other guy. It's broken into 2 parts: bodily injury liability and property damage liability. Bodily injury pays for the medical bills, lost wages, and pain and suffering of people you injure in an accident you cause. Property damage pays to repair or replace their car, or anything else you might hit, like a mailbox, a storefront, or a guardrail. When you see those numbers on your policy like 50/100/25, that's what they're referring to. In this example, it would mean your insurer will pay up to $50,000 for one person's injuries, $100,000 total for all injuries in a single accident, and $25,000 for property damage. Now, you might be thinking, okay, my state only requires me to have 25/50/25. I'll just get that. It's the cheapest option. And you would be making one of the most dangerous financial decisions of your life, because those minimums are a trap. They were set decades ago and are catastrophically low for the modern world. Think about it. $25,000 for property damage. What happens when you slide on some ice and your Toyota Camry rear ends a brand new Tesla Model S? Or a Porsche? or a Ford F-350, the repair bill for those vehicles can easily soar past $50,000, $60,000, even $70,000. Your $25,000 policy pays its limit, and then guess who's on the hook for the other $45,000? You are. They will come after your savings. They will garnish your wages. They will put a lien on your house. All because you tried to save a few bucks a month on your insurance. But that's not even the scary part. The truly terrifying risk is bodily injury liability. Let's imagine a scenario. You're driving home. You glance down at your phone for just 1 second to check a text. In that second, the car in front of you stops. You slam into them. It's not a huge crash, just a fender bender. Everyone seems okay. But the person you hit is a neurosurgeon. The impact jammed his wrist, causing a hairline fracture and nerve damage. He can no longer perform surgery. His career is over. His lifetime earning potential was estimated at $10 million. So he sues you for medical bills, for rehabilitation, and for $10 million in lost future income. And he will win. Your state minimum $50,000 policy is a single drop of water in the face of that financial inferno. The insurance company pays its $50,000, wishes you the best of luck, and walks away. You are now personally responsible for the remaining $9,950,000. Your life as you know it is over. This is not a scare tactic. This happens every single day. This is why liability coverage is the most important part of your policy. The cost to increase your liability limits from the state minimum to something substantial like $250/500/100 is often surprisingly small, maybe the cost of a few cups of coffee a month. But the difference in protection is the difference between a bad day and a ruined life. So when an insurer calculates your premium, the liability limits you choose are a massive factor. The higher the promise they have to make, the more they have to potentially pay out for you, the more you'll pay for that promise. Okay, so that's the coverage for the other guy. What about you? What about your car? That's where the next two toppings come in. Collision and comprehensive. Collision coverage is simple. It pays to repair or replace your car if you are in an accident that is your fault. You run a red light and T-bone someone? Collision covers your car. You back into a pole in a parking lot? Collision covers your car. You swerve to miss a deer and hit a tree? Collision covers your car. If you have a loan or a lease on your vehicle, the bank will almost always require you to have this coverage. They have a financial interest in that car, and they want to make sure their asset is protected. Now, when you buy collision coverage, you also have to choose a deductible. A deductible is the amount of money you have to pay out of pocket before the insurance company pays a dime. It's typically $500, $1,000, or even $2,000. It's basically your skin in the game. It's designed to stop people from filing claims for every tiny little scratch and ding. So let's say you have a $1,000 deductible, and you cause an accident that results in $5,000 of damage to your car. You pay the body shop the first $1,000. Your insurance company then pays the remaining $4,000, and this is a huge lever on your premium. If you choose a low deductible, say $250, you're telling the insurance company, I want you to be on the hook for almost everything. That's a bigger risk for them, so they're going to charge you a higher premium. If you choose a high deductible like $2,000, you're telling them, I'm willing to handle the smaller stuff myself. I only need you for a major disaster. That's less risk for them, so they'll give you a lower premium. Finding the right balance between a monthly premium you can afford and a deductible you could actually pay in an emergency is a critical decision. The third main topping is comprehensive coverage. This is sometimes called other than collision coverage. It's for all the weird stuff. It's the acts of God and bad luck policy. Comprehensive pays for damage to your car that wasn't caused by a collision with another vehicle or object. A deer runs out and you hit it? That's a comprehensive claim. A hailstorm turns your car into a golf ball? Comprehensive. A tree branch falls on your hood during a windstorm? Comprehensive. Your car is stolen? Comprehensive. It gets flooded? Vandalized? Catches on fire? All comprehensive. Just like collision, you'll have a deductible to pay. And just like collision, the value of your car is a huge factor in the price. It costs more to replace a stolen $40,000 SUV than a stolen $5,000 sedan. So the comprehensive coverage on the SUV will cost more. So you have these three core components. Liability to protect you from lawsuits. Collision to fix your car after a crash you cause. And comprehensive to fix your car from theft, weather, and all kinds of other mayhem. Each one is a separate promise from the insurance company. And the size of each promise, the liability limits you choose, and the deductibles you select for collision and comprehensive are dialed in by you. You are literally building your own policy. A bare-bones, state minimum liability-only policy is the cheapest pizza on the menu. A policy with maxed-out liability limits, low deductibles, and a dozen other add-ons is the extra-large with every topping in the house. The insurer looks at the specific promises they are making to you, calculates the risk of having to fulfill those promises, and prices your policy accordingly. We've now priced the risk of the car itself, and we've priced the risk of the policy you've built. But there's still one giant, variable, unpredictable factor left. The one thing that sits in the driver's seat and connects the car to the policy. The person holding the keys. Because who you are is the next and arguably most personal piece of the entire pricing puzzle. So let's talk about you. And the first thing insurance companies want to know is, how old are you? Because in the world of car insurance, age isn't just a number. It's a multi-chapter story of risk. The story begins with the most expensive chapter. The teenage driver. A 16-year-old license fresh in their wallet represents the single highest risk an insurance company can take on. It's not personal. It's a brutal calculation based on millions of miles driven by their peers. They lack the thousands of hours of instinctual split-second decision-making that older drivers take for granted. They're more likely to be distracted, more likely to speed, more likely to misjudge a corner or a braking distance. The statistics are chilling. For every mile on the road, drivers aged 16 to 19 are nearly 3 times more likely to be in a fatal crash than drivers 20 and over. So when an insurer sees a 16-year-old on a policy, they don't see a person. They see a probability curve that is screaming, danger. And the premium reflects that scream. As you move into your early 20s, the price starts to ease up, but you're still in a high-risk category. The data shows you're driving more, often at night, and still building that crucial experience. But then you hit a magic number. For many drivers, that number is 25. Insurers have found that, on average, this is the age where the risk curve takes a significant dip. Life often gets a bit more stable, the prefrontal cortex is fully developed, and the driving habits are more ingrained. It's one of the first major age-related discounts you'll receive, without having to do a single thing. From 25 up to around 65 is generally considered the sweet spot. This is the prime time for insurance rates. Drivers in this bracket are seen as the safest bet. They have decades of experience, they often have families and are more risk-averse, and they have the lowest accident rates per capita. If all other factors are equal, a 45-year-old will almost always pay less than a 25-year-old. But then the story takes another turn. As drivers enter their late 60s and 70s, the rates often begin to slowly creep back up. This feels incredibly unfair to many seniors who are excellent, cautious drivers. And it's not because insurers think they're suddenly reckless. It's for 2 statistical reasons. First, things like reaction time, vision, and hearing can naturally decline with age, which can increase the likelihood of an accident. Second, and more importantly from a cost perspective, older drivers are more fragile. A minor fender bender that a 30-year-old might walk away from could result in serious injuries for a 75-year-old, leading to much larger medical claims under that personal injury protection or medical payments coverage we talked about. The risk of a costly payout increases, so the premium does too. Next, the algorithm looks at your gender. Now this is a controversial one, and it's changing. For decades, the data was undeniable. Young men, particularly under the age of 25, crashed more, got more DUIs, and were involved in more fatal accidents than young women of the same age. As a result, their insurance rates were significantly higher. However, a growing number of states are now viewing this as discriminatory. States like California, Hawaii, Massachusetts, Michigan, and Pennsylvania have banned insurance companies from using gender to calculate premiums. In these states, a 20-year-old man and a 20-year-old woman with identical cars and driving records will be quoted the same price. It's a trend that's likely to continue as regulators question whether broad demographic categories are a fair way to assess individual risk. Along those same lines, the insurer asks, "Are you married?" Feels invasive, but to them it's another simple data point. Decades of claims data have shown a powerful correlation. Married people, on average, get into fewer accidents and file fewer claims than single people. The thinking is that marriage is often an indicator of stability and responsibility, which translates to safer, more predictable behavior behind the wheel. So, if you're married, you'll often see a small but noticeable discount on your premium. It's not a judgment, it's just the law of large numbers playing out. Now we get to where you live. Not just the state, but your specific 9-digit zip code. This is one of the most powerful factors in your entire premium. You and your identical twin with the same car, same driving record, and same age could have wildly different insurance rates if you live just 10 miles apart. Why? Because insurance is priced at a hyperlocal level. Living in a dense, urban center like Chicago means more traffic, more intersections, more parked cars to hit, and a higher likelihood of theft and vandalism than living in a quiet, rural town 50 miles away. Insurers have data on the claim frequency of every single neighborhood. They know the rate of vehicle theft on your block. They know which intersections have the most accidents. They even factor in the weather. A zip code in coastal Florida that's prone to hurricanes carries a different risk than a zip code in Arizona. Even the local legal climate matters. Is your area particularly litigious? Do juries in your county tend to award huge settlements in accident lawsuits? If so, the insurer's potential cost of a claim goes way up, and that risk is priced into your policy, and your neighbors and everyone else in your zip code. You're not just paying for your risk. You're paying for the collective risk of where you park your car at night. But of all the personal factors, the most controversial, the most misunderstood, and for many people the most infuriating is your credit score. Yes, your financial history has a direct impact on how much you pay for car insurance in most states. Now, it's not your standard FICO score that lenders use. Insurers use a specialized version called a credit-based insurance score. They take information from your credit report, things like your payment history, how much debt you carry, and how long you've had credit, and run it through an algorithm designed to predict one thing: how likely you are to file an insurance claim. The industry's justification is this: massive studies have shown a direct, undeniable statistical correlation between how people manage their finances and how they manage risk in other parts of their life, including driving. According to their data, a person with a lower credit-based insurance score is statistically more likely to file a claim, and those claims are often more expensive. To an insurer, this makes you a higher risk, and they price your policy accordingly. Critics, however, argue this is profoundly unfair. They say it penalizes people for life events that have nothing to do with their driving ability, like a job loss, a divorce, or overwhelming medical debt. It creates a cycle where people facing financial hardship have to pay more for a mandatory product, making their situation even more difficult. And there's evidence it can disproportionately affect lower-income individuals. Because of this controversy, some states, including California, Hawaii, and Massachusetts, have banned the practice entirely. But for the majority of the country, your credit history remains a silent but powerful co-pilot in determining your insurance rate. Finally, we arrive at the most obvious and most personal factor of all: your driving history. This is your resume as a driver, and insurers read it very, very carefully. A clean record with no accidents or violations is the single most valuable asset you have. It tells the company you are a low-risk, profitable customer, and they will fight to keep you. But every blemish on that record comes with a price tag. A speeding ticket? That's a surcharge, and the cost goes up depending on how fast you were going. An at-fault accident? That's a major red flag. Expect your rates to jump significantly and stay elevated for 3 to 5 years, which is the typical look-back period for most insurers. And then there's the ultimate sin in the eyes of an insurance company: a DUI or DWI. This is a catastrophic event for your insurance. Your rates will skyrocket, often doubling or tripling. And that's if your insurer doesn't drop you altogether, forcing you to find coverage from a special high-risk provider at an astronomical cost. So you've got the car, you've got the coverages, and the insurance company has a complete profile of you. But the price isn't set in stone just yet. There's one final layer of control you have: a series of choices and hidden opportunities that can dramatically swing the final number on your bill. And that's where we get into the real strategy: the discounts, the deductibles, and the details you can actually negotiate. Let's start with the most direct trade-off you can make: your deductible. Think of your deductible as your share of the risk. It's the amount of money you agree to pay out of pocket for a collision or comprehensive claim before your insurance company opens its wallet. And this creates a fundamental seesaw in your policy. The higher your deductible, the lower your monthly premium will be. The lower your deductible, the higher your premium. Why? Because from the insurer's perspective, a high deductible means two things. First, you're taking on more of the financial burden yourself, which obviously reduces their potential payout. But second, and more subtly, it means you're far less likely to file small nuisance claims. If you have a $1,000 deductible, you're not going to file a claim for a $700 bumper scratch. You'll just pay for it yourself. This saves the insurance company a massive amount in administrative costs. They reward you for this self-restraint with a lower premium. So which should you choose? A low deductible of, say, $250 feels safe. It means a surprise accident won't derail your finances. But you are paying a premium for that peace of mind every single month, whether you have an accident or not. On the other hand, raising your deductible from $500 to $1,000, or even $1,500, can slash your collision and comprehensive costs by anywhere from 15 to 40%. That's real money, hundreds of dollars a year. But it comes with a critical warning. This is not free money. You are accepting the risk. The golden rule is this: never, ever set your deductible higher than an amount you have readily available in an emergency savings account. If you choose a $1,000 deductible to save $25 a month, but you don't actually have $1,000 saved, you're not being smart, you're gambling. You're betting your financial stability against the odds of a car accident. And that is a bet that eventually everyone loses. The smart play is to choose the highest deductible you can comfortably afford to pay tomorrow, without hesitation, and then bank the monthly savings. Okay, so you've set your deductible. Now we enter the world of discounts. This is where the game is truly played. Most people think of discounts as a small perk, but the reality is that your final premium is often determined by how many of these you can stack. Think of it like building a house of cards. Each individual card is flimsy, but when you stack enough of them, you create a solid structure of savings. Let's break them down. First, there are discounts about you, the driver. Are you a student? Maintaining a B average or better can often net you a good student discount, sometimes up to 25%. Insurers have mountains of data showing that responsible students tend to be responsible drivers. Have you taken a defensive driving course? Many states and insurers offer a discount for completing an approved course. It might cost you a small fee and a Saturday afternoon, but the 5 to 10% discount can last for 3 years, paying for itself many times over. Think about your profession and affiliations. Are you a teacher, a first responder, an engineer, or a scientist? Many companies offer discounts to people in what they consider to be low-risk professions. Are you a member of the military, a veteran, or part of an alumni association or a professional organization like a union or a credit union? These groups often have partnership agreements with insurance companies that can unlock preferred rates you can't get anywhere else. You have to ask. These discounts are rarely applied automatically. Next are the discounts about your car. We already know that a safe, boring car is cheaper to insure, but you can drill down further. Does your car have anti-lock brakes, automatic emergency braking, lane departure warnings, or daytime running lights? Each of these can shave a little off your premium. What about anti-theft devices? A passive alarm that arms itself automatically, or a GPS tracking system like LoJack, makes your car less likely to be stolen, reducing the comprehensive risk. That's a discount. Even the simple act of VIN etching, where the vehicle identification number is engraved on the windows, can sometimes earn you a small price break because it makes the car harder for thieves to part out and sell. But the real heavyweight champion of discounts comes from how you structure your policy. This is where the biggest savings are found. The most famous is the multi-policy, or bundling discount. Combining your auto insurance with your homeowner's or renter's insurance policy from the same company can be the single biggest discount you can get, often saving you up to 25% on both policies. Why is this discount so huge? Because it makes you a sticky customer. An insurance company knows that a customer with just one policy is always shopping around. But a customer with 2 or more policies is far less likely to go through the hassle of switching everything. You become a more predictable, long-term source of revenue for them, and that stability is incredibly valuable. They are willing to give you a massive discount in exchange for that loyalty. The same logic applies to the multi-car discount. Insuring 2 or more cars with the same company is almost always cheaper than insuring them separately. Then there are the simple administrative discounts that people overlook. Paying your premium for the full 6 or 12-month term up front, rather than in monthly installments, can often save you 5 to 10%. This is because it eliminates the administrative work and the risk of a missed payment for the insurer. Signing up for paperless billing and automatic payments from your bank account does the same thing. Each is a small discount, maybe 3 to 5%, but remember, we're stacking them. Finally, there's the concept of loyalty itself. Some companies offer a loyalty discount after you've been a customer for a certain number of years. But this is a double-edged sword. While it feels good to be rewarded for your loyalty, it can also lead to complacency. A phenomenon known as price optimization is a quiet, controversial practice in the industry where some insurers will gradually increase the rates of loyal customers over time, betting that they won't go through the trouble of shopping for a new quote. They figure your loyalty means they can charge you a little more than a new customer. This is why the ultimate power you have, the master key that unlocks all the best prices, isn't a discount at all. It's the willingness to shop around. Your current insurance company has no incentive to offer you their absolute best rate if they think you're not going to leave. The single biggest mistake consumers make is setting up a policy and then letting it automatically renew year after year without ever checking the market. You should be getting competing quotes at least once a year, and you absolutely must shop around anytime you have a major life change. Getting married? That's a call to your agent. Married couples are statistically safer drivers and get lower rates. Moving. A new zip code can dramatically change your premium, up or down. Buying a house? That's the perfect time to bundle. Starting a new job with a much shorter commute? You're driving less, which means you're less of a risk. That should be reflected in your bill. When you call your agent or a new potential insurer, don't just accept the first number they give you. Come prepared. Ask them directly. I'm currently paying X, and I'm looking to see if I can find a better value. Based on my driving record and my vehicle, are there any other discounts I might qualify for? You'd be amazed what can suddenly become available when they know you are an informed consumer who is actively comparing their options. This isn't about being confrontational. It's about being an active manager of your own finances. By understanding the levers you can pull, your deductible, the vast array of available discounts, and the competitive pressure of shopping around, you transform from a passive price taker into an active price maker. You put yourself in the driver's seat of your own policy. But being in the driver's seat of your policy means understanding the whole vehicle, not just the steering wheel and the pedals. It means knowing about the complex engine humming under the hood, the powerful, often invisible, algorithm that truly determines your fate. We've talked about the things you can see and control, like your driving record in your car. Now we're going to pull back the curtain on the hidden factors, the controversial data points that insurers use to build a profile of you that is far more detailed than you could ever imagine. This is the black box of car insurance pricing. And the first, most controversial component inside that box is your credit score. Now hold on. You're probably thinking, what on earth does my Visa bill have to do with my ability to merge onto a highway? And that is a perfectly reasonable question. Insurers in most states, not all, as California, Hawaii, and Massachusetts have banned the practice, don't use your FICO score, the one you see when you apply for a mortgage. Instead, they use something similar called a credit-based insurance score. They take information from your credit report, things like your payment history, your level of debt, the length of your credit history, and they run it through their own proprietary formula. Their justification for this is based on a mountain of data and one core correlation. The industry has found that, on a large statistical level, people who are more responsible with their finances also tend to be more responsible behind the wheel. The logic is that a person who pays their bills on time and manages debt well is likely to be more cautious, more forward-thinking, and less likely to take unnecessary risks, whether that's co-signing a bad loan or trying to beat a yellow light. They argue it's not about how much money you have, but how you manage what you do have. According to their studies, this correlation is so strong that your credit-based insurance score can be a more accurate predictor of future claims than your actual driving record. Let that sink in. Your financial habits could be telling them more about your future risk than your past driving performance. This is, understandably, where a lot of people cry foul. Critics argue that this practice is fundamentally unfair. It penalizes people who have hit a rough patch, a job loss, a medical emergency, a divorce, things that can wreck a credit score but have absolutely no bearing on a person's ability to drive safely. It can disproportionately affect lower-income individuals, recent immigrants who haven't had time to build a credit history, or young people just starting out. They argue it's a proxy for income, creating a system where poorer people with perfect driving records can end up paying significantly more than affluent drivers with a history of accidents. The debate is fierce. Insurers see it as an indispensable, statistically valid tool for accurate pricing. Consumer advocates see it as a discriminatory barrier that punishes people for life events, not driving behavior. But regardless of which side you're on, the reality is this. In most of the country, the ghost of your financial past is riding shotgun every time you get a quote. But if using your financial history feels like an intrusion, the next evolution in insurance pricing is going to feel like a full-blown surveillance operation. We're talking about telematics, or as it's more commonly known, usage-based insurance. This is where the insurance company stops guessing what kind of driver you are based on proxies like your age and credit score, and instead just watches you. They do this through a small device you plug into your car's diagnostic port or, more commonly now, through an app on your smartphone that uses its sensors. This technology tracks your every move behind the wheel. Not where you're going, they are adamant about that, but how you get there. It measures things like heart-braking events. Are you constantly slamming on the brakes, indicating you're following too closely or not anticipating traffic? It tracks rapid acceleration. Are you peeling out from every stoplight like you're in a drag race? It monitors the time of day you drive. Are you frequently on the road late at night, especially on weekends when accident rates are statistically highest? It tracks your mileage. The less you drive, the less risk you represent. Some even track phone usage while the car is in motion. It's building a high-definition portrait of your actual real-world driving habits. The sales pitch for telematics is incredibly compelling. It's the ultimate promise of fairness. Why should you, a safe and cautious driver who only uses your car for a quiet commute, be lumped into the same risk pool as the guy who weaves through traffic on his phone? With telematics, your rate is no longer based on demographic averages. It's based on you. Your premium is a direct reflection of your actions. Good drivers get rewarded with significant discounts, sometimes as much as 30 or 40%. It's a powerful incentive for safer driving across the board. If people know that every hard brake and speedy acceleration is being logged and could affect their wallet, they're more likely to drive defensively. It turns every trip into a small driving test where you're graded, and your grade translates directly into dollars and cents. But this promise of personalized pricing comes at a cost: your privacy. You are voluntarily handing over a massive stream of personal data to a for-profit corporation. While they promise they're not tracking your location, the app on your phone certainly can. And what happens to this data? Who has access to it? Could it be subpoenaed in a legal case? Could it be sold to data brokers or used for marketing? Could a data breach expose the driving patterns of millions of people? Furthermore, the algorithm's judgment can feel arbitrary. A single hard brake to avoid a child running into the street looks identical to the algorithm as a hard brake from tailgating. A necessary, quick acceleration to merge safely onto a busy freeway could be flagged as aggressive driving. The system tracks the what, but it has no understanding of the why. You are putting your financial fate in the hands of an algorithm that sees your driving as a series of data points, stripped of all context. This is the new frontier. The black box is becoming transparent, but only to the insurer. They are moving away from the old model of broad categories and towards a new model of hyper-personalization. And it doesn't stop with credit scores and telematics. Other, smaller data points are constantly being fed into the machine. Your occupation, for example. An actuary might determine that delivery drivers or journalists who are on the road all the time are a higher risk than a librarian or a software engineer who works from home. Even your marital status can play a role, as data suggests married individuals tend to file fewer claims. The algorithm is a complex tapestry woven from dozens of threads. Your age, your gender, your location, your driving history, your vehicle, your chosen coverages, your deductible, your credit history, and now potentially your second-by-second driving behavior. Each piece of information refines the picture, allowing the insurer to calculate the odds, to predict the future with ever-increasing accuracy. What you are actually paying for is no longer just a shared risk among a pool of similar people. You are paying for your own, unique, algorithmically determined probability of costing the insurance company money. The journey from a simple premium to this point has been a long one, driven by data and technology. The question we all have to answer now is, as this technology gets even more powerful and more personal, where do we draw the line? That line is being drawn and redrawn every single day, right now in the palm of your hand and under the hood of your car. The first major step across that line is called telematics, or usage-based insurance. You know it by brand names like Progressive Snapshot or State Farm's Drive Safe and Save. It's presented as a simple, fair bargain. Let us watch you drive, and if you're a good driver, we'll give you a discount. Feels like the ultimate meritocracy. What could be more fair than paying a price based on your actual real-world driving habits? On the surface, it's a brilliant evolution. Instead of relying on broad, clumsy proxies for risk like your age or your zip code, the insurer can now see the truth. They give you a little dongle to plug into your car's OBD2 port, or more commonly now, you just download an app on your smartphone, and it starts watching. Tracks your mileage, sure, but it's watching so much more. It's logging every time you brake too hard, every time you accelerate too quickly. It knows if you take corners like a race car driver, It knows the time of day you're on the road, penalizing you for late-night drives, which are statistically more dangerous. Some apps can even tell if you're using your phone while the car is in motion. For millions of people, this is a great deal. They get a 10, 20, even 30% discount for proving what they already knew, that they're safe drivers. The insurance company wins, too. They get a mountain of granular data to refine their risk models, and they attract the safest drivers who are the most profitable customers. Seems like a perfect win-win. But the moment you look closer, the cracks in this perfect system begin to show. The data has no context. Imagine you're driving down a residential street, and a child runs out from between two parked cars. You slam on the brakes, stopping just in time. You're a hero. But the algorithm doesn't see a hero. It sees a heartbreaking event. It sees a data point identical to a reckless driver who floored it to a red light and slammed on the brakes at the last second. The algorithm doesn't know why you did what you did. Just knows what you did, and it penalizes you for it. Or consider a nurse who works the night shift. She has to drive home at 3 a.m. The roads are empty. She's a cautious driver. But the app flags her for consistently driving during high-risk hours. Her premium goes up not because of her driving but because of her job. The data is punishing her for her profession. The same goes for a delivery driver in a dense city. They spend all day in stop-and-go traffic, with constant acceleration and braking. The algorithm sees them as a high-risk driver, when in reality, they're just navigating the environment their job requires. The promise of a purely objective system is a mirage. The data is objective, but the world it's measuring is not. It's creating a new form of digital redlining, where your lifestyle, your job, and your neighborhood can be used against you with terrifying precision. And this is just the beginning. The data we're giving them now is child's play compared to what's coming. Many new cars, especially electric vehicles, are essentially rolling supercomputers. They have dozens of sensors and cameras. A car like a Tesla has a camera inside the cabin pointed directly at the driver. Right now, it's used for features like making sure you're paying attention while autopilot is engaged. But what happens when your insurance company wants access to that footage in the event of a crash? They could see if you were looking at your phone, if you were drowsy, if you were eating a cheeseburger. They could argue you were distracted and therefore more at fault, potentially denying your claim. Gets even more personal. Think about the smartwatch on your wrist. It tracks your heart rate, your sleep patterns, your stress levels. What if that data could be subpoenaed after an accident? Your Honor, the driver's heart rate was elevated by 20 beats per minute right before the collision. He was clearly experiencing road rage. This isn't science fiction. The data exists. The only thing stopping this is regulation and public outcry. We are one precedent-setting court case away from our own biometric data being used to determine our financial liability. And then there's the holy grail of automotive technology, vehicle-to-everything or V2X communication. This is the idea that cars will constantly talk to each other, to traffic lights, to infrastructure. A car up ahead hits a patch of ice, and your car knows about it instantly and can preemptively adjust. It has the potential to eliminate the vast majority of accidents. It's a safety revolution. But it's also a privacy nightmare. It means your vehicle is broadcasting its location, speed, and trajectory every single second of every single day. Who owns that massive city-sized fire hose of data? The car manufacturer? The government? Your insurance company? Can they use it to build a predictive model of your future behavior, adjusting your premium in real time based on the route you choose to take to work? This relentless march toward hyper-personalization threatens the very foundation of what insurance is supposed to be. For centuries, insurance has operated on a simple, powerful idea: the pooling of risk. It's a social contract. We all pay into a giant pot of money. The lucky many who don't have an accident use their premiums to cover the costs for the unlucky few who do. The safe driver implicitly subsidizes the risky driver. The young subsidize the old. The healthy subsidize the sick. It's a system of communal financial support that protects individuals from catastrophic, random events. But this new model, this data-driven quest for the perfect price, systematically dismantles that social contract. If every single person is charged a premium that is a perfect one-to-one reflection of their individual predicted risk, then the pool is gone. There is no more sharing of risk. There is only you and the cold, hard number the algorithm assigns to you. And what happens to the people the algorithm deems uninsurable? What about the 18-year-old male who, through no fault of his own, is statistically a massive risk? In the old model, his high premium was still subsidized by the rest of the pool. In the new model, his premium could be so astronomically high that it effectively bans him from driving. What about the person with a minor medical condition that slightly increases their risk of an accident? Or the low-income worker who lives in a high-risk zip code and has to work 2 jobs, meaning more time on the road? If insurance becomes a luxury that only the statistically perfect can afford, what does that do to our society? It fundamentally breaks the promise of mobility. The ability to drive to a job, to a doctor's appointment, to a grocery store, becomes a privilege reserved for those who can pass a data-driven purity test. We are, without even realizing it, building a future where an algorithm can decide if you're allowed to participate in the economy. The state insurance commissioners, the regulators who are supposed to protect us, are struggling to keep up. The technology is evolving 100 times faster than the law. They're grappling with questions of algorithmic bias, data ownership, and transparency. If an AI jacks up your rates, you have the right to an explanation, but what if the explanation is just a 1,000-page printout of code? The black box is making the decision, and we are increasingly being asked to just trust it. So when your insurance company offers you that discount in exchange for an app on your phone, you're not just making a simple financial decision. You're casting a vote. You're voting on a future where risk is no longer a shared burden, but a personal scarlet letter, assigned to you by a machine. The journey that started with simple actuaries looking at birth certificates and marriage licenses has led us here, to a precipice where the price of your insurance is becoming the price of your freedom. The question is no longer just, what are you paying for? The question is, what are you willing to give up? To save ourselves, we are being offered a deal, a new covenant. The insurance industry, recognizing the cracks in its own foundation, is extending an olive branch. They say, we hear you. You're tired of being judged by where you live, by your credit score, by your age, or your marital status. You believe you're a good driver. So prove it. The solution they offer is called telematics, usage-based insurance. It has friendly names like Snapshot or DriveWise or RightTrack. It comes in the form of a small device you plug into your car's diagnostic port, or an app you download on your smartphone. The promise is simple and seductive. Let us watch you drive, and we will reward you for being safe. We will finally break free from the old proxies and judge you on what actually matters, your actions behind the wheel. The price of your insurance will no longer be a reflection of your demographic group. It will be a reflection of you. And on the surface, it sounds like the fairest system imaginable. A true meritocracy of the road. Why should a cautious driver in a supposedly bad neighborhood pay more than a reckless driver in a good one? Why should a young person with a perfect driving record be penalized for the sins of their age bracket? Telematics promises to sever those archaic ties. Promises to give you, the individual, control over your own premium. Drive well and you save money. It's that simple. The data doesn't lie. It tracks heartbreaking sudden acceleration, the time of day you drive, your mileage, and in some cases even your phone usage while the car is in motion. It's the ultimate arbiter of truth. No more assumptions. No more stereotypes. Just cold, hard data. And millions of people have accepted this deal. They've plugged in the device, downloaded the app, and invited the insurance company into the passenger seat. They've traded a slice of their privacy for the promise of a discount. But here is where we must look closer at the fine print of this new covenant. What does it mean to be watched? When you brake hard, the system logs it as a negative event. It doesn't know that you slammed on the brakes because a child chased a ball into the street. It just sees a data point. Aggressive driving. When you accelerate quickly to merge onto a busy highway, a necessary and safe maneuver, the algorithm may flag it as recklessness. When you drive home from a late shift at the hospital or a night class, you are penalized for being on the road during high-risk hours, regardless of your perfect attention. The system is not judging your skill or your intent. It is judging your data against a predefined, opaque model of what it considers safe. You don't get to see the algorithm. You don't get to question its logic. You are being graded by a black box and its judgment is final. And that discount you were promised? It's often not a discount from a fair market rate. Instead, the industry is subtly creating a new, higher baseline for everyone, and participation in their surveillance program is the only way to get your premium back down to a reasonable level. It's less of a reward for good behavior and more of a penalty for demanding privacy. The choice is no longer just, how much do you want to pay? The choice is, how much of yourself are you willing to give away to afford to drive? We are entering an era where your freedom of movement is becoming conditional. Conditional on your willingness to be perpetually monitored, scored, and judged. This single number, this driving score, is becoming a new kind of credit score, a behavioral score that determines not just your insurance premium, but potentially your access to car loans, your eligibility for ride-sharing platforms, or even your employability in jobs that require driving. We are, piece by piece, building a system where every mile is logged, every turn is analyzed, and every stop is scrutinized. The data streams from our cars are becoming one of the most valuable commodities on the planet, and we are the product. This data isn't just for calculating your premium. It's a gold mine. It can be sold to marketers who want to know which coffee shop you pass every morning. It can be used by city planners to model traffic, or by corporations to decide where to build their next warehouse. And in some cases, it can be subpoenaed by law enforcement in legal proceedings. You're not just paying for insurance with your money anymore. You're paying with a detailed minute-by-minute record of your life. Your habits, your routines, your locations, your entire pattern of existence, transmitted and stored in a server you'll never see. And this is all happening just as we stand on the cusp of the greatest shift in transportation since the invention of the automobile itself: self-driving cars. When a fully autonomous vehicle gets into an accident, who is at fault? Who pays? Is it the person in the driver's seat who wasn't actually driving? Is it the car's owner? Is it the manufacturer like Tesla or Ford? Or is it the company that wrote the code, the artificial intelligence, that made the decision to swerve or to brake? The very concept of individual driver liability, the bedrock of car insurance for a century, is about to evaporate. The future of insurance won't be about insuring millions of individual, fallible human drivers. It will be about insuring a handful of colossal tech companies and their fleets of autonomous vehicles. The risk will be consolidated. The premiums will be paid not by you and me, but by Google, Apple, or General Motors. They will be insuring their algorithms. And in that world, the data they collect from their vehicles won't just be about assessing risk. It will be about perfecting their product and proving their software is safer than a human's. Your every trip will be a data point in a global beta test, and the price of admission will be the complete and total surrender of your privacy on the road. So, what are you actually paying for? You're paying for a century-old promise, born from a freak accident on a summer day in Ohio, that if the worst happens, you won't be alone. You're paying into a massive collective pool, a system designed to spread the cost of unpredictable tragedy among the predictable many. But you're also paying for the biases and judgments of the past. You're paying for the statistical shadow cast by your zip code, your credit score, your age, and your education. You're paying for a complex and often ruthless business model that sees you not as a person, but as a collection of risk factors, a line item on a balance sheet. And now you are being asked to pay with something more. You are being asked to pay with your data, with your privacy, with the intimate details of your daily life. You are paying to subsidize a system that is desperately trying to predict the future by watching your every move in the present. The simple act of buying car insurance is no longer a simple financial transaction. It has become a referendum on your personal philosophy. It's a choice between the cost in dollars and the cost in freedom, between the anonymity of the past and the surveillance of the future. The price of your policy is no longer just a number on a piece of paper. It is the price of your participation in modern society. It is the toll you pay to access the very freedom that the open road once promised to all of us. And so the ultimate question is not what the insurance costs you, but what it costs to be you.